So let's bring in Eddie Gabor, managing partner at Key Advisor Groups, for that conversation. Eddie, thanks a lot for coming on. What do you mean when you say, keep it simple, invest in what you know? What is the takeaway or the high level theme that investors should be thinking about here?
Well, look, as more and more do-it-yourself investors come into the marketplace, first, I think that's great because they're getting exposure and learning about the stock market. Investors need to start with what they know. And why I say that is it's really difficult in this environment, in any environment, frankly, to try to value a business if you're not familiar with that industry or that space. Basically, you're buying stocks blindly, in my opinion, when you do that. So I advise folks that invest their own dollars that if it's not an area that they're comfortable enough coming up with their own conclusion, is maybe to go hire a money manager that is their expertise is in that space. That way they can get some research and information so they can make an informed decision versus just buying something blindly or just on a hunch. Because again, in my opinion, if you do that, it could end badly for you.
And so I guess that does make an interesting point here, and that is you understand maybe the secular trend and the companies that are going to be tied to it, and you could say people staying home and getting subscriptions. That to me means I think Netflix is an interesting name or whatever it might be. How do you approach now going out there and finding a way to get some sort of an idea around not necessarily a valuation in terms of an exact dollar amount, but just some sort of idea of maybe in a group of names where some sort of attractiveness might be coming from a valuation standpoint? What's your approach to that?
Well, that again is why, as a do-it-yourselfer in this environment, I've said it all along. Right now, I feel like this is one of the most difficult environments to make proper investment decisions because from a valuation standpoint, we could make an argument that some of the best sectors to be in right now are really overvalued based off of fundamentals. And because right now there is a disconnect between fundamentals in regards to valuations and the stock prices continue to go up. The biggest question I'm getting right now is why does the market continue to go up when the economy seems to be sputtering along? And so what we tell people is just make sure you're not overly exposed to one area, because if you are and you're staying, all of your stay-at-home stocks is what you're investing in, then when that space takes a hit, your entire portfolio has a big chance of losing a lot of money. So the hardest thing for do-it-yourself investors to do is to really stay diversified and disciplined and not be overweight any one particular sector. Because let's face it, the stay-at-home stocks are the hot stocks right now, and it's difficult not to chase that.
And so I think it's an interesting point you say about getting diversified here. And so if we're looking at diversification, so I think that leads into having target weightings or a certain percentage of your portfolio. Say you want allocated to each sector. So now, do you go after sort of a cap weighting where you just try and mimic the S&P 500? That is, let's say 20% of it or 25% is IT, so I need 25% of my portfolio there? Or do you go for more of an equal weighting, everyone gets 10 or 12%? What's your approach to say putting some sort of a target in terms of diversification and how you allocate your investing dollars out?
So when you're building these portfolios, at least for us in our practice, we customize it based on the client's need. Frankly, there's not a one size fits all because it does depend upon their risk tolerance, if they need income, if they don't need income, if they're really income driven, then you're going to focus on dividend stocks. But whatever weighting you do select, it's important and prudent, in my opinion, to make sure that you're rebalancing the portfolio. I find that as one of the toughest things for investors to do because when you rebalance, you're actually selling your winners and you're buying your losers. And sometimes it's very difficult to do that. But again, many times doing that is what's going to give you the best long-term risk management approach to give you the better returns. Because at the end of the day, you want to buy low and sell high. And that's why whatever sector weightings you decide to do, staying diversified and rebalancing that strategy is crucial to make sure it's successful long term.
And I guess then if you're looking at that and you're saying, okay, I feel like markets have gotten a little bit detached from fundamentals. There's some volatility on the horizon. I want to maybe move into cash. Is that something you would think about doing here? Maybe if you're an investor who maybe we'll say 5 or 10 years to retirement, is that something you could look to do here? Is move some of your investments into cash in the sideline?
Absolutely. Look, I think cash is one of the most underused asset allocation strategies in a portfolio. We have cash right now for some of our clients sitting on the sidelines due to some of the uncertainty, due to their specific scenario. And what we've done is when we've seen big drops in the market, is we've dollar cost averaged that cash into a portfolio. So again, everybody's situation is different, but there's a reason why the saying is cash is king. So having cash in a portfolio during uncertain time periods, I think is a necessity for most investors because again, you can't take advantage of the drops if you don't have cash.
All right. All right. Thanks a lot, Eddie. Really appreciate you coming on and sort of giving your read through on the markets right now.